Hello, every investor. Welcome to Smart Investing with Philippe. This is the time for market update. The market just closed, and we're not going to waste a lot of time, but I invite you to stay until the end of this video so we understand clearly where we are sitting right now in the market, looking through the key levels and what will be the probability for the next steps in the market. So let's jump into it right now. Thanks. Okay, let's start with the Nasdaq. You can see that it has clearly broken the 200 moving average, which is never a good idea. And it's a sign that the sell-off is actually at its ends, because it's like a last flush before the market just start to recover slowly. I mean, usually it happened in the past a few times, when it goes much lower than the 200, because it flushed the last weekends, like we say in the market, and everyone that was not holding like highly conviction stocks or company, and they were not too sure about this, and they have this psychological effect on their mind. They think that everything is break loose and everything is going to collapse, and the end of the world is coming, so they run for the exit. So I would say that this is probably what happened today. You have the last weekends that actually was selling, because they were too afraid that with the worst case scenario happening in the market. So having said that, what is quite interesting is to see that the RSI now has break below the 30 limit, which really show that we are well below the oversold level that we saw back in September 22, when we saw back in August 24, when you have the unwinding of the carry trade with the Japanese yen and US dollar. So I think you can be sure that there will be a technical rebound at least before maybe the market recovers on the way up, or it will continue to go on its way down. But again, this is all about the speculation that we see about the tariffs and Donald Trump comment during the weekend. I invite you to see my video I did this morning with quite it's like a face-to-face conversation with you, and then what you shouldn't do during this market crash or during a market correction, and how to avoid to be a loser in this type of market. So I invite you to really watch this video, because there are a lot of lessons that you can learn from my experience and also from the past, if you really pay attention to what happened already in the past. I mean, so far what we have lost from the peak on the QQQ is about 13%. 13%. Just let me tell you that we actually see much more downside on August last year. Remember August last year, we saw a market down of 15%. So we almost close to what we saw last August, and probably what we saw also. Yeah, what we saw also on July, August in 2023. So you see, we saw that in 2023, we saw that in 2024, and it happened already. It happened usually once a year. So again, this is not out of ordinary to see the index going down or correcting by minus 15, 20%. This is not unusual. This is part of the normal process. I know there is a lot of uncertainty with the tariffs. Donald Trump said they don't care about the market. The economy is going to go through some transformation, and that what is important is to get the economy of the US back on track and become stronger and less dependent on what we've done in the past. But I think that the market is overreacting to something new. I mean, definitely the macro policy of the US has changed dramatically with Donald Trump. And Donald Trump number one back in 2016 and Donald Trump 2024 is very different. He's much more populist, so they don't know exactly what to expect. I mean, and remember, back in 2016, he would never say that he doesn't look at the market, and he doesn't really care what the market is doing. So that's a big difference, but that probably spooked a lot of investors. But again, all the headlines and all the social media and also the media, the mainstream media and so on, they are playing with your fear. So again, pay attention. I don't say it's not painful. I mean, I'm in the stock market like you. I can feel the pain also. But this is a temporary this is a temporary pain. I mean, it has always been a temporary pain. Whether it lasts 1 month, 2 months, 3 months, 4 months, 1 year, like back in 2023, it never lasts so long and forever. Eventually the market recovers. I mean, what I have to tell you is that pay attention to what is happening. Don't panic. If you can afford to hold for the long run, just hold for the long run. Don't run for the exit because you might regret it. So again, there is no guarantee the market cannot go lower than what it is today, but it's likely there is more probability that it will go up in the coming months when this uncertainty will vanish and we will have a clearer picture of what the economy will be doing under the new Donald Trump. So what is interesting, if we switch from the daily and the weekly chart, we have a clearer view of where the market is sitting, because when you take a weekly chart, you have a more like long-term trend view of the market. And you can see that on the weekly chart, the QQQ is actually sitting on the lower level of the Bollinger Bands, and also it's sitting right onto the 55 moving average. So you see, it's not that dramatic, I would say. It's not a level that you should start to panic and run for the hills and just abandon everything you're doing. So let's go now to the S&P 500. The story on the daily first, and then we move to the weekly. So the daily, again, it went through clearly the 200 moving average like the QQQ, and you can see that the RSI now is clearly touching the 30 level like back in July, August last year, and back also in April in 2024. So again, remember in August last year, the S&P 500 lost also 9%. Now we are losing close to 9%. So you see exactly the same level as August last year. I remember that when we feel the pain last year in August, I remember everybody was also panicking. It's the end of the world and everything. But at the end, you see from the low of the August last year to the end of 2024, the market has risen quite significantly. It has risen close to 20% from the low of August last year before now correcting again. But if you do a quick Fibonacci level, you would see what has been the retracement so far on the increase from the low of August last year, So now we are sitting more or less at the 0.61 Fibonacci level. So it hasn't touched yet. We are actually giving back 50% of the gains that we had from the low of August last year, and we are probably going to touch the 0.61 retracement level of the Fibonacci. I mean, if you can see, the 50% is the yellow line just right here, and probably we are going to touch and test the 0.61 level, which is about 550 for the SPY. But going much lower than that to the 0.78 is very, very unlikely. This is very unlikely. At least we should see a technical rebound before probably going lower, but going straight from the top of the Fibonacci retracement to 0.78 is very uncommon for the stock market to do. But again, nothing is impossible, so we have to watch out and we have to see what investor wants to do. Now, if you move to the weekly chart on the SPY, it's also give you a clear indication more of the long-term trend view of the markets from a technical standpoint, that we are sitting right into the 55 moving average, and the low, and we have actually break slightly the Bollinger Bands of the S&P 500 on the weekly chart, which is also a sign that the market is clearly oversold. And what is also interesting is that from the RSI standpoint, we are clearly at the level of 40, which was the level of October 2023. You know when the market actually corrected about 10% again. I mean 10% for the S&P 500 to retrace. You see, one time, two times. I mean, once a year also that they does that. So I mean, if it just do it in February, March, I mean, we are done for the whole year for retracement of 10%, 10 to 15%. So you see, that means maybe the rest of the year is going to be great and fantastic. But are we expecting a recession? Are we going to see a recession in 2025? I really doubt so, because there is Jerome Powell said the economy is in a good shape. The employment market is very strong. And inflation level, although it's slightly increasing, is not out of control. And they want to see inflation going back, and they want to see more proof that the employment market is weakening before they can start to decrease rate. So again, the authorities and the government, also the Fed, is not showing any sign of panic, and that everything is actually broken in the economy. But again, the market is discounting a lot of uncertainty and a lot of fears. So it's normal that it's correcting from the high level and the high valuation level we've seen in many stock in the S&P 500. And this is a lot of the Max 7 and the momentum stock that are mostly correcting more than the value side of the market or the dividend side of the market, or more like the defensive side of the market. So there is a bit of rotation and a big sell-off from the high valuation from these, I would say, high growth, high speculative name and retail names. So again, I don't see anything out of the ordinary from these two indices, although that it's very painful to see red into your portfolio. I have exactly the same feeling as you, and I don't really panic, and I don't really run all over my fear. Of course, I'm like you. I feel also a bit of disappointment. You also feel a bit of anger, because you say, oh, I should have better know that I should have sold in December because the valuation was at the highest, was not sustainable, and so on. But I can just do that on my head for 1,000 times. It doesn't change the fact now that we corrected 10 to 15% depending on the index, and then you are in the middle of the ocean with a lot of storm. Then is the jumping out of the ship at this level is actually a nonsense. You already take the most of the hit. So I don't think that you should jump the ship and just go and try swimming in the storm. Better to not have left for the sea. But now we have left for the sea. Just ride the wave and just try to go safely back to the shore, Anyway, never mind. TLT slightly increased today, but not as much. That means the run to safety into bond market is not happening, to my opinion. It's normal that it's rising more or less 1%, but it's not like a huge jump in the bond market that you can say that all that money that came out of the equity market is actually going straight to the bond market, because otherwise the increase of the bond price would have been more than 1% on the 20 years. The VIX definitely increased massively. I mean, you see the VIX now touching the 27, and 27 is exactly the highest level of December 2024. So you remember we had a bit of a spike in volatility at the end of the year 2024. And remember that spike in volatility just reduced dramatically in 1 week. And the market did continue to rise up to the end of 2024. So, it's not because the volatility is increasing, then the market is not going to calm down and just start to recover. Usually, seeing a high VIX number, like we see back in August last year, it went even to the 70. it's a sign that it's a time to buy. If you buy each time the VIX is at this level, then you would never really lose money, because the market recovers, and then after that you just continue the rise in the market. So I don't think that you should start to panic, but it's a good sign that the VIX now is at 27, and we will see if it will go up much higher than 27. But again, we have to be patient and just to realize that the buying opportunity is not when everybody is buying and the VIX level is at the lowest, is when everybody is selling and the VIX at the highest, so that you have the opportunity in the market to make some good deals. If you have, of course, the dry powder and the cash to do so, and also you have the fortitude to do that when the market goes down, and of course you have the conviction that the market will recover and it's not the end of the world from today onwards. So the next index that we can see, and is the one that I'm the most frustrated about, is IWM, which is the small cap index. You can see it was trading before in this channel, the channel that I'm going to put in red. Hold on. Okay, hold on. Okay, let's put it in red so you can see clearly this channel here, and this channel here. Okay, you see the two red lines, this one and this one. It was traded before this, between these two levels, like up and down, up and down, up and down, for almost 2 years, from 2022 to 2024. That means for 2 years you get up and down, and the market do absolutely nothing. And then suddenly, December 23, when the Fed just clearly said, okay, we're not going to increase rate anymore, now we are in a path of we're going to decrease rate, then it was the sign for the small cap to start to rally. And it rallied from the level of 200 to 245, which is 20% increase in 2020. 20% increase. Hold on. Yeah, it was a 20% increase from the level of the end of 2023 to the end of 2024. So in 1 year, then you have a 24% increase if you actually play the breakout of this channel that was happening for 2 years. And now it has fully given back all the gains of 2024 to come back clearly at the upper band of the channel that was traded for the last 2 years between 2022 and 2024. I mean, that's very frustrating. That means that if you are now looking at the level of IWM, it's exactly at the same level back in 2022. So that means for the last 3 years, exactly, the IWM has done absolutely nothing. So that means you've lost money. You've lost money due to inflation. But this IWM and small cap is highly frustrating. You would think that the rotation would play in favor of small cap, because we're still expecting rate to decrease and not to increase. And we're still expecting, even though there is a lot of tariff, then the domestic companies should benefit more from this increase of tariff than the international companies. But again, obviously the market has corrected much more on the small cap than the large caps. I mean, it's also the small cap has always been perceived as the high risk of the equity market, which is not always the case. Now the IWM has corrected of more or less 17%, flirting with the bear market level of minus 20%. What you can see also is that the level of volume at this level is extremely high. And it will be extremely unlikely that it will go much lower than this level, because otherwise we go back straight to the channel. the channel we've been trading between 22, 24, then we go back straight into it, and then it will be very, very hard to get out of this channel again. And that's dead money. And I'm invested. I can feel the pain. I'm invested in IWM, and I can feel the pain because this is highly frustrating. And if you look at, you've listened to Tom Lee and all these pundits on the CNBC channel and all these news channel, they were seeing a small cap rallying more than 50% in 2024. And it never happened. It just rallied a bit in 2024, but it gave all back in 2 months in 2025. So you back to zero, you know? Anyway, and you see the volume of sale today, this week, is big. You know, it's very, very big. Look at today, the volume is quite big also. You can see the uptick in volume is quite interesting because the sell-off is accompanied with a high volume. And you can see the RSI is well below the 30. It's flirting with limit that we have never seen since a long time. If you look at the 5 years and on the daily, you see, the last time we saw the RSI level was back in 2023. How is that possible, you know? Anyway, never mind. The fact that the RSI is very, very low is that there is not a lot of steam left into the redemption, into the selling of the small cap. So it might actually start to hover around this level because it's a key critical support, you know. Remember this channel, we are just rebounding just on the upper band of this channel, you know, and this is not a coincidence. A lot of traders see that as a psychological level for the IWM. If it breaks significantly that level, that means we are all the way down to 173. And that's a catastrophe because this is terrible, you know. I can't understand this is happening. If we go down to all this, that's going to be a crash of 30%, you know. But what is warranting a crash of 30% in small cap? It's not overvalued. It's not like we have seen a huge rally in the small cap like we've seen for the large cap and for the tech sectors, you know. Anyway, this is what it is. Let's observe what will happen in the coming days. Otherwise, if we look at some stocks specific, you can see that AMD is holding very strongly the 0.78 level of the Fibonacci. I told you that if it breaks that level, then it will retrace totally from the upside that it had from the low of 2023. And obviously, the valuation of AMD is amazing at this level, you know. And I don't think, despite that we see a huge drop in the market the last few days, you can see, and last week, you can see that it's holding firmly this Fibonacci level retracement. So I don't think it will go much lower. Other than that, you can see that SMCI also is holding really well. You know, it didn't sell off a lot compared to all the retail name and high beta names in the market. It just did a small correction of 3.5%, which is not much compared to Palantir, another 10%. I mean, compared to Mara, another 16%. And trading now in the lower band of the trading channel, there has been through all 24. And Coinbase the same, minus 17%. But of course, these names are correlated to the Bitcoin, and Bitcoin has corrected massively by more or less 16%. I mean, Bitcoin now, it's trading at 80,000, and I think it will probably touch this level of 73,000 before making a pause, because otherwise it will re-enter again the channel that we see the whole year of 2024. It was oscillating between 72,000 and 56,000. You see, so the level of 73,000 for Bitcoin is extremely important, technically speaking, you know. Other than that, if you look at the Max 7 has corrected another 5%, and now we are breaking massively through the 200 moving average. Now we have corrected more than For all the names, 22%. So we are officially into a bear market for the Max 7. So if you believe in the long-term story of the technology company and the Max 7, and you were frustrating with the high valuation back in December, I mean, now is your time to buy. Is your time to buy these companies. If you were ready to buy them in December at the level of 58, why are you not buying it at the level of 46? Do you know what I mean? So again, and if you look at the retracement level, now we are probably back at the 50%. Let me see what is the retracement level, just to quickly do it. So you had a high of, oh la la, up, yes. Now we are back on the 0.61%, 0.61 retracement level of Fibonacci. So that means you have actually given back 60% of your upside from the low of August 2024, which you saw a massive correction in Max 7. So you see, it's a healthy retracement of the stock price and valuation. So maybe for those who dare to do it, it's very good to start to nibbling into the Max 7, because these are strong companies. I don't think that you should worry too much. I look into the portfolio. Tesla is not much invested into this Max 7 fund. I saw that Tesla is the lowest rate in this holding, which is good because Tesla is the one that has corrected the most, with minus 15% again today. And you can see that the stock price of Tesla has actually lost 50% over the last 2 months. 50%, can you imagine? Look at all the YouTubers and all the thumbnail, go back to the history. Then they will tell you that from the 500 level, they will say, oh, it's 1,000 and to the moon from that level. But no, it's 50%. So if you lose 50% on your share, that means you need a 100% increase to recover your loss. Just bear in mind this, That's why you should never chase the hype, and you should never try to go into this pump and dump scheme, Otherwise, that's pretty much it today for the market and for the update of the market. So again, don't panic, don't sell if you don't need the money for the next year or the next 2 years. You have to hold on. You have to trust that you have the right companies and the fundamentals are good. You have to trust that all this uncertainty in the market with the tariffs and the economy and the impact on the economy, this is all speculative right now. We don't see anything showing that we will have a recession. This is all speculative. There is nothing in the number. Unless you think you disagree with what I say, please leave a comment and tell me what indicators you see that is telling us that we will have a recession this year in 2025. Do you see? This is all speculation. Even the Fed said there is no sign of recession so far in the US economy. So the Fed there is plenty and thousands of people working full-time on the US economy. So if they knew there will be a recession coming, they would start to decrease rate because they will not play with this, So again, if you like this video, I thank you so much for watching this video, and I please subscribe to the video, push the like button and leave a comment. So this will help me to reach more people and to really make sure that they understand how the market is working and to navigate the tough time with them, so they can feel that they are not alone in this market, and we also all suffering in this downturn. But it's also important to support each other and to understand the long view of the market. And if you are ready to lose, that means you're going to win in the long run. There is no pain, no gain. That's what we say. So you need to be able to withstand the loss in order to win. If you are happy, you do plus 100%, then you should be not to worry that it does minus 15. You understand? So again, subscribe, like the video and leave me a comment, and tell me what you think about this market. Have a good evening and relax. See you tomorrow. Bye.